Hello world, welcome to Farm the Market. Let's talk about short selling. Typically, in the investing world, the main premise is to buy something that we expect will increase in value over time, therefore generating a positive return for the investor. That's what we refer to as going long. However, another way to invest or to speculate is to bet against an asset, expecting it will drop in value over time, and to capture that move we can go short, selling the asset today, expecting to buy it back in the future at a lower price. Short selling turns around the logic of the old saying, buy low and sell high. Short sellers look to sell high and buy low. In general, that's the premise behind short selling, and applies to a broad spectrum of assets. To get into more detail, from this point onward, we will use short selling stocks as an example. This will give us a good idea of the implications of short selling, the mechanics, the risks, and so on. Many of these concepts will be similar to what applies to other asset classes, but it's imperative that you always do your own research. The figures presented here are indicative. Let's review some key concepts, implications, and requirements for short selling. Asymmetric risk. Perhaps the most important thing to understand about short selling is that the risk is asymmetric. On the way down, the stock can only go as low as zero, while to the upside, in theory, it can go to infinity. That means your gains are capped, while your loss can be many times over your initial investment. Margin account. Since you will be selling something you don't own, collateral will be needed to mitigate the risk associated with your open short position. For example, in the US, the initial margin requirement is usually 50% plus 100% of the short sale value, 150% in total. In other words, you cannot withdraw the cash received from the sale. Therefore, you must fund your account with at least 50% of the notional amount you plan to short and keep the cash received from the sale in the account. Depending on the broker or market conditions, the margin requirements could be higher. Borrow stock. You cannot sell something you do not own. That's called naked short selling, and it's illegal. Therefore, you first have to borrow the stock you want to short, and that has a cost. The cost varies greatly depending on the demand for the stock. The stocks included in the so-called hard-to-borrow list may have fees above 20% per year. Maintenance margin. Once your position is open, the price of the stock will fluctuate, and with that the margin requirements. The maintenance margin is the minimum amount that must be available in the account once the trade is open. The maintenance margin can vary greatly, but let's assume for our example that it is 25%. Leverage. You can open a short position using only 50% of the notional amount you are exposed to. Therefore, you are effectively using leverage. This is a double-edged sword. In percentage terms versus your initial investment, it will amplify your potential gains, but also your potential losses. Less control over your position and the strategy. I don't want to be repetitive, but it's important to remember that you go short by selling something you don't own, and therefore you have less control over your position overall. For example, there are restrictions about when you can open a short position, like the uptick rule. If this rule is in place, you cannot open a short position unless the trade takes place at a higher price than the previous trade. Another example is that your broker can demand the stock back at any time, and you might have to close your position even if your strategy does not call for it yet. Short squeeze. This is an extreme case of losing control over your position, lately popularized by the so-called meme stocks like GME and AMC. The options market is also playing a huge role in the meme stocks phenomenon, but for now we will just stick to analyze a typical short squeeze. We will talk about the gamma squeeze in another video. So, basically, a short squeeze happens when a stock that is heavily shorted has a sudden price increase that forces short positions to cover to stop their losses. Covering a short position means buying the stock and therefore rising the price further, forcing more shorts to cover. It becomes a vicious circle for shorts, just adding more fuel to the fire. The asymmetry and leverage mentioned before play a huge role in short squeezes. Your thesis about your short position in the stock might be sound and even correct in the long term, but a short squeeze can kick you out of the trade before it comes to fruition, with costly consequences. What could be considered heavily shorted? In order to answer this question, let's look at two metrics. Short interest ratio. Short interest refers to the total number of shares sold short. When you divide the short interest by the average daily volume, you get what is known as the days to cover ratio. This ratio gives you an idea, in theory, of how many days it would take short sellers to cover the whole position if needed, in average trading days. In general, if this ratio is higher than 10 days, the stock can be considered heavily shorted. Short interest as a percentage of float. Floating stock, also known as just float, is the actual number of shares that are available to trade in the open market. In general, a stock with a short interest as a percentage of float above 10% is considered heavily shorted. Now, let's look at a simplified example of a short position. We will ignore costs and commissions. It's one thing to talk about how theory works, but I think it's important to look at the numbers to really grasp how the margin requirements can affect a short position. Let's assume you do your research about a stock that has been having a hard time, and you conclude that it is destined to fail. Therefore, you want to take advantage of that and decide to short the stock. The stock is trading at $100 per share, and your plan is to short 1,000 shares. The notional amount is 100,000 US dollars. Assuming you already have a margin account ready, and the balance right now is zero, given the initial margin requirement of 50% of the notional amount, to open the trade, you first deposit $50,000 in your margin account and execute your trade at market close. Your position looks like this on day one. Now, let's look at two possible outcomes. First, the positive one for the short seller. First, let's review how the maintenance margin and the total margin is calculated. For the maintenance margin, the 25% we mentioned earlier will be calculated based on the notional amount at market value. The notional amount at market value just means the total number of shares in the position times the current market price. The total margin requirement will be the result of adding up the current notional amount at market value and the maintenance margin. To simplify the example, we will assume all calculations are made at market close. So, one day goes by after you open your position, and the stock price moved against you. At the close of day 2, the stock is 5% up. Now you have an unrealized loss of $5,000. Given your initial investment was $50,000, it's important to notice that you are already down 10%. Here's the leverage at play. Margin-wise, the collateral available in your account is still greater than the total margin requirement. Therefore, there's no margin call. At the close of day 3, the stock is up again. Now it is 20% up versus the initial price. Although the margin requirement grows, there's no margin call yet. You have an unrealized loss of $20,000, or you are down 40%, however you want to look at it. Again, leverage at play. At this point, one good question to ask yourself could be, in a situation like this, would I have the conviction to hold my position, or would I panic and take my loss? Leverage can kick you out of a position easily. Do not underestimate it. At the close of day 4, the stock is up again. Now it is 30% up versus the initial price. With this move, you will receive a margin call. the total margin requirement is higher than the collateral available. Therefore, you would have to deposit at least $12,500 to cover the difference. If you don't cover the margin call, your broker could kick you out of your position, forcing you to take the loss. Here comes into play the loss of control over your strategy we talked about earlier. Also consider that even though we are keeping the unrealized P&L simple in percentage terms, and we will keep measuring it against the initial deposit of $50,000, now with the margin call, the capital you have deposited has increased, so the trade has become more capital intensive. At the close of day 5, the market gives you a breather. The price drops to 120, and with it the total margin requirement. Now, in theory, you could withdraw the $12,500 you deposited the day before. That's called a margin release. At the close of day 6, the stock does what you thought it would do in the first place, drop in value. It closes at $50, 50% down versus the initial price. At this point, you decide to take your profit. You close your position by buying back the stock at $50. Now leverage plays in your favor. If we consider the initial investment of $50,000, you doubled your money, making a 100% return. Even though the ride was bumpy, you made some good money. Now, let's look at the second example. The stock price moves the same way for the first 4 days, as in the previous example. But this time around, on day 5, the price keeps going up and in a big way. The stock is up 75% versus the initial price. You receive a second margin call. Given the leverage, you have broken the threshold where your unrealized P&L is now greater than the initial investment. You are down $75,000. The capital required to keep the trade open has increased greatly. Even with this move, you stick to your thesis and decide to hold your position. You put together all the money from your savings account and barely cover the margin call. At the close of day 6, the market keeps moving against you, and effectively it squeezes you out of your position. With the stock price at $200, another margin call comes in. You have no more savings left and decide it's not a good idea to borrow money to cover the margin call. So, it's time to close your position. You decide to cover, in other words, to buy back the 1,000 shares at $200 each. The result of the trade, you lost $100,000, twice your initial investment. The asymmetry and leverage we discussed earlier played against you. Again, these are overly simplistic examples, but I think they convey the key ideas and risks behind short selling, and how a short squeeze can kick you out of your position faster than you think. Short selling is neither good nor bad. It's just another way to participate in the market. If you found this information useful and interesting, please don't forget to like this video. If you haven't already, I invite you to subscribe to the channel and turn on notifications so you don't miss future videos. Remember that everything presented here is for educational purposes only. Thanks for your time.